हॅलो.
हॅलो हॅलो. हाय सॉरी. गुड आफ्टरनून. इथे हे देत नाही काय PPT. हे करायला लागतं का कधी कधी. दे शुड बी डुप्लिकेट का एक्सटेंड ऑलवेज ना. हां तेच. आणि असं ट्रंकेटेड का. पण आता हे असं नाही दिसायला, नुसतं फुल दिसायला पाहिजे ना. हां काय करू. मी फक्त स्लाइड शो केला. सो आय डिड जस्ट दिस. वरचा काय गेलं. आता आलं. हां काय. हाताची जादू आहे तुझी. चल ठीक आहे. थँक्स. खऱ्या अर्थाने युजर फ्रेंडली आहे. खऱ्या अर्थाने युजर. अरे बिस्किट घेणार काय. थँक्स. Hello students, so welcome to the ICWAI final paper 20A Strategic Performance Management and Business Valuations Spm&Bv. So this is CACS Pushkaraj Vishnu Joshi, and I'm taking you through the entire subject, and in today's session in a way we are going to look into the module 7, which is about, already we are in the process of looking at module 7, which is about business valuation methods and approaches, and in that there are 4 chapters, out of which in another session I have already completed the first chapter, which is about discounted cash flow analysis, comparable transaction method, comparable market multiples method, market valuation, economic value added approach, free cash flow to equity, dividend discount model, net asset valuation and relative valuation. So this chapter 1 is already covered in the other session. Now in today's session, just a second. Yeah. Sure. So today we are seeing the chapter 2, which is about earnings multiples. Now this is another angle of how the multiples for earnings have to be considered while valuation is being done by the registered valuer. What are the aspects? So there are various approaches which are involved in earnings multiple. One is a market approach, which is called as relative valuation. So this valuation method estimates an asset's value by comparing it to identical or similar asset with available price data. So as the name suggests, it's a market approach or relative valuation. So if a particular asset is to be valued, then the valuation method in such relative valuation method, the estimation of a value of assets value is done by comparing it to identical or similar assets which are available in the market and with the available price data from the market. So when to apply, typically use the market approach. So one has to use the market approach when the asset was recently sold under relevant conditions. The asset or similar ones are actively traded publicly, and there are frequent and recent comparable transactions. So if at all there is a market comparability which is available for a particular asset to be valued, and similar kind of a transaction in terms of that particular identical or similar asset has been done in the recent past, then this valuation method, relative valuation method, can be applied. And when not to rely solely upon, so one should, the valuer should be able to also understand when not to rely on it, and for that purposes such valuation, relative valuation, should be avoided or supplement the market approach if the business or its comparables aren't actively traded. Secondly, comparable assets are limited or too different, there is no similarity at all, and transaction data is outdated or unavailable. In such scenario, relative valuation is not to be relied upon. So these are the criteria, you can say, when to apply relative valuation and when not to apply relative valuation. So let's see in market approach the valuation methods that are used. Equity multiples. So over here the ratios are used like price earnings or price to sales, etc. Second approach is, or second method in market approach or relative valuation, is the enterprise value multiples. So over here the valuer uses EV upon EBITDA or EV upon revenue. So enterprise value is equal to market value of equity minus cash minus short-term investments, and equity value is calculated as enterprise value minus liabilities minus preference shares. So these are the formula for enterprise value multiples one can consider too. Then comes the second method of market price method. So market price method over here, one has to use the volume weighted average price, which is called as VWAP, over a reasonable trading period to avoid distortions from single day price fluctuation. For example, market prices as on 31st March 2020 were unusually low due to COVID-19 impact, but normalized over the time. So that's the market price method, applicable for assets traded in active markets. If an asset is traded in multiple markets, use the market with the highest trading volume for valuation. So these are the characteristics of market price method in terms of relative valuation, and more so while considering earnings multiples. So if an asset is traded in multiple markets, use the market with the highest trading volume for valuation, and ensures this particular method ensures a more stable and accurate valuation by averaging out short-term volatility. This valuation method estimates an asset's value by comparing it to identical or similar assets with available price data. Then comes the second method after the market price method is the comparable companies multiple method, that is CCMM. So again, just to clarify for the students and the listeners of this session, I have restricted myself for the entire session, and that's what I have been told also, and my practice has been to refer to the study material of the institute, and it's a classic study material, well exhaustive, decently and presentably prepared, covering the entire aspects of strategic performance management and business value. Of course, I am too small to vet or judge the study material, but as a practitioner or as a consultant, obviously I do keep on referring to the study materials of our institute, and they are absolutely priceless and worth always useful for references in your practical professional assignments and life also. So that's what I have been following, and during my entire sessions for this particular subject, I have strictly followed the study material that has been provided, and especially the entire chapters that are there in the study material, I have tried to summarize in a crisp and concise, exam oriented, focused way, and accordingly my PPTs have been prepared. So I thought I'll just highlight it once again before we proceed with the subject. So the comparable companies multiple method. So if at all my notes or my session falls short of any conceptual explanation, then please refer back or fall back on the study material concepts and the entire study material that is available. So yeah, coming back to the comparable companies multiple method, CCMM. So comparable companies multiple method, also known as relative valuation, values an assets by comparing its valuation multiples to those of similar actively traded companies. So that's how that's why it's called as a relative valuation. It's related to similar kind of identical actively traded companies valuation. So steps to be followed in CCMM are: identify comparable assets and gather their market values, standardize these values using price multiples to enable comparison. Now what are the price multiples that should be taken, etc., we will see as we go along with the session. So standardize these values using price multiple to enable comparison. Compare the assets multiple to those of its peers, adjusting for firm specific differences to assess under or overvaluation. So obviously whenever there is a comparability, it won't be really like apple to apple or orange to orange comparison. To some extent there will be some differences or distinguishing factors, and for these differentiation factors one will have to make some adjustments for the differentiation with the peers, and therefore compare the assets multiple to those of its peers while adjusting for firm specific differences to assess under or over valuation of that particular asset. So these are the three steps. First step is identify comparable assets, gather their market data or market values, standardize these values using price multiples to enable comparison, find a reasonable, rational, common factor for comparison, and thereafter compare the assets multiple to those of its peers, adjusting it for the firm specific differences, thereby assess whether the valuation, existing valuation, is overvalued or undervalued. So continuing with CCMM, the key metric or the price earnings, so the key metrics we will see. So the first key metric that is looked upon for comparison is the price earning ratio. So PE ratio, what is popularly known as. PE ratio is equal to market price per share divided by earnings per share or EPS. So a higher PE suggests a stock is more expensive relative to earnings. So vis-a-vis comparison to earnings, the value which is being fetched by the, at which the stock is available in the market is relatively higher. That's what the higher PE suggests. So higher PE suggests a stock is more expensive. More expensive means costlier relative to the earnings that particular stock or the company is showing. So in a way it reflects investor sentiment and growth expectations. So because the market is fetching higher value or is expensive vis-a-vis the earnings of that particular company, in a way it reflects the investors' sentiments and the growth expectations from that particular stock or company. Earnings yield is equal to 1 divided by PE ratio, an estimate of expected return. So that's what the earnings yield formula is, 1 divided by the PE ratio. And market price per share is equal to EPS into PE multiple. So that's how the PE ratio is calculated. And this is the formula. Types of PE ratios. So trailing PE, that is TTM. So trailing PE is based on actual earnings over the last 12 months, most commonly used. Forward PE. So these are the types of PE ratios that are being considered by the valuer in terms of relative valuation or comparable companies multiple method. So that's how the types of PE ratios have been. One is the trailing PE. Trailing PE means based on actual earnings over the last 12 months, commonly used. Forward PE is based on forecasted earnings for the next 12 months, less reliable during volatile period. So trailing PE is what is more commonly used or is popular because in a way it reflects the past trends. Forward PE to some extent is less reliable during volatile periods, because it is based on the forecasted earnings for the next 12 months, and if there is a huge amount of volatility, then in that case it becomes less reliable. Variance depends on how price and earnings are defined. Example, recent year, average, future estimate. So this could be the variance, and variance depend on how price and earnings are defined. A note, valuers often prefer trailing PE, that's what I said, from continued operations to exclude one-off or non-recurring items for more accurate valuation. So that's the well accepted PE ratio or the trailing PE ratio of past 12 months that is being followed by the valuers, especially from continued operations, and thereby excluding one-off or non-recurring items for more accurate valuation. Then comes the fundamental PE, that is justified PE. So what is meant by fundamental PE, justified PE? The fundamental PE ratio, also called as the justified PE, is derived from the Gordon growth model, that is GGM, wherein V0 is equal to D1 divided by R minus G, dividing both sides by next year's forecasted earnings, E1, we get the leading PE ratio. So the formula typically is V0 divided by E1, that is the forecasted earnings, is equal to D1 divided by E1 divided by R minus G. So that's how the formula is. This form shows that the justified fundamental PE is based on dividend payout ratio, that is D1 upon E1, required rate of return, that is R, and expected constant dividend growth rate, that is G. So that's precisely the Gordon growth model, wherein dividend growth rate is being considered over here. So the key points in fundamental PE or justified PE is that it is called justified because it's grounded in valuation theory and reflects the intrinsic value. Secondly, it is forward looking, that is leading ratio and not a trailing ratio, using forecasted earnings, that is E1, rather than past earnings. So this is a distinctive factor again. And thirdly, it clarifies how PE should align with the firm's fundamentals, serving as a benchmark for valuation. So these are the key points of fundamental PE or justified PE. Then another earnings multiple that is being considered is the book value multiples. Book value multiples is price to book ratio, that is PB ratio. The price to book ratio or PB ratio compares a stock market price to its book value per share. PB ratio is equal to market price per share divided by book value per share. So that's how the calculation is. And key insights over here, typically in terms of the book value multiples, would be a low PB ratio might indicate that a stock is undervalued, but it could also signal underlying issues. Secondly, industry context matters. So PB ratio is especially useful in asset heavy industries like banks. And thirdly, the ratio is influenced by accounting practices because it uses values from the balance sheet. So that's what typically the ratio is influenced by accounting practices, because it is all based on the balance sheet of the organization. Then comes the estimation consideration. So in estimation consideration, the future book value per share can be projected using the sustainable growth rate, that is equal to, that is G is equal to ROE into retention rate. Adjustments to book value. So adjustment to book value is revalue fixed assets, example PP and E, to reflect fair market value. It includes off balance sheet liabilities, example guarantees, contingent liabilities, excludes non-operating intangibles. So these are the adjustments to be made to the book value before being considered for price to book ratio. So that's what it means. Excludes non-operating intangibles, example goodwill, but retain operating intangibles like patents or copyrights. This ratio helps assess whether a stock is priced appropriately relative to its net asset value, particularly in firms where tangible assets play a key role. So that's what it means. Then let's look into the another earnings multiple, which is called as revenue multiples. So price to sales ratio or PS ratio. Price to sales ratio measures a company's valuation related to its revenue. The PS ratio is calculated as market capitalization divided by total revenue trailing 12 months, or on a per share basis, wherein current stock price is divided by sales per share. So the key points typically in such revenue multiple are that it is useful for startups or loss-making companies where profit-based metrics like PE or EV divided by EBITDA aren't applicable. Lower the price to sales ratio generally suggests better value, but the ratio should not be used in isolation. It should be considered with other multiples also. This ratio is best suited for growth companies with strong and consistent sales growth. The PS ratios can be volatile. It requires careful interpretation alongside other financial indicators. Then comes another multiple, that is earnings multiple, is price to cash flow, P to CF ratio. So price to cash flow, P divided by CF ratio, is a valuation metric comparing a company's market value to its cash flows. P to CF, market capitalization divided by E, is equal to market capitalization divided by total cash flow, that is equal to stock price divided by cash flow per share. So types of cash flow used in this ratio are PAT plus non-cash charges minus simplest but omits some non-cash items. So this is the simplest method of cash flow, that is PAT plus non-cash charges, because it omits some non-cash items. Now this typically second type of cash flow that is used is adjusted cash flow from operations, CFO, more refined than the first one. Free cash flow to equity, that is FCFE, so most appropriate, reflects cash available to the shareholders. And EBITDA, which is often used but influenced by accruals, not a pure cash flow measure. The key points to price to cash flow ratio are that PCF, P to CF is helpful when earnings are distorted by non-cash items. It provides a clearer view of a company's ability to generate actual cash, and FCFE is preferred for its accuracy in reflecting shareholder value. Then comes the another earning multiple, which is the enterprise value divided by EBITDA, EV to EBITDA ratio. So the EV to EBITDA ratio, also known as the enterprise multiple, is used to value cash generating businesses by comparing their overall business value to operating earnings. So this is the logic for which the EV to EBITDA ratio is used. It's precisely used to value cash generating business. So whatever businesses that are cash rich or cash generating, by comparing their overall business value to operating earnings. Formula wise, this ratio is calculated as EV divided by EBITDA, that is enterprise value EV divided by EBITDA, where EV is equal to market capitalization plus debt plus minority interest plus preference capital minus cash, and EBITDA is equal to PAT plus interest plus taxes plus depreciation plus amortization. This way the formula or the calculation of EV to EBITDA is done. Then comes the key characteristics of this ratio. So EV represents the theoretical acquisition cost, but it would take to what it would take to buy the business debt free. So in short, if at all a particular business is to be bought and there are certain debts over there, and if that business is to be bought without the debts, then what will be the value at which it should be bought? That's what it means. So therefore EV, enterprise value, represents the theoretical acquisition cost, in the sense what it would take to buy the business debt free. The second characteristics of this ratio is that EBITDA allows comparison across companies by removing the impact of capital structure, taxation and non-cash charges. So EBITDA formula itself, if you see PAT plus interest plus taxes plus depreciation plus amortization. Third characteristic is, unlike EV to EBITDA is not influenced by financing decisions, it does not reflect actual cash flow and is susceptible to accounting manipulation. So these are the unique characteristics of EV to EBITDA ratio. Lastly, equity value can be inferred is equal to enterprise value minus debt. So that's what equity value is. Advantages of this ratio are that it is better for comparing companies with different capital structures, because accordingly the debt is being considered, and reflects total business value, making it ideal in M&A analysis. Now in continuation with this earnings multiple, typically let's see the comparable transaction method now. Another method, or also called as guideline transaction method. So the CTM, or the comparable transaction method, values a company based on multiples from recent transactions involving similar companies or assets. It's especially useful when publicly traded companies are unavailable, such as in private or niche industries. Key steps. So typically what it means is that whenever there are no comparable companies, it's easier to have comparable transactions to be looked upon. And therefore especially useful when publicly traded comparables are not available as such as in private or niche industries. The key steps involved in CTM or comparable transaction method are identify relevant comparable transactions, example same industry, size, geography. Extract transaction multiples, example EV divided by EBITDA or EV divided by revenue from those deals. Adjust for differences between the subject, asset and comparables, example size, stage, performance, etc. Apply adjusted multiples to the subject company's relevant metrics and assess the range of values if using multiple metrics, and use judgment to finalize the valuation. So just for the sake of the listeners, typically the study material has given the various concepts, and I have tried to put it across in the simplistic own words, what you can say, trying to understand or make understand the concept that has been mentioned in the study material. So these precisely the key steps, you will find it in the study material itself, which I have tried to simplify it out over here. So apply adjusted multiples is the fourth step to the subject company's relevant metrics, and then finally assess the range of values if using multiple metrics, and use judgment in finalizing the valuation. Let's take an example, or rather it's given in the study material itself. In valuing an Indian education tech startup where no listed comparables exist, private equity transactions, example Byju's or Vedantu, which are the popular apps or the ed tech companies, can serve as benchmarks. For early stage firms, size discounts may be applied. So this is how the comparable transaction method is being calculated, also called as guideline transaction. Because why guideline? Because then the previous transaction becomes the guideline for that particular valuation which is being done by the registered valuer. Furthermore, sector specific multiples are being used. These are used when accounting data is limited or unreliable, focusing on operational metrics. So typically industry wide or industry wise metrics are being used. For industry like steel, value per ton of steel produced is being used. Electricity, so this is another comparable transaction method. In comparable transaction method, another earning multiple would be sector specific multiple. So for steel industry, the sector specific multiple that is being considered or metric that is being used is value per ton of steel being produced. Electricity, value per kilowatts generated. In case of subscriptions, example ISPs or Netflix or internet service providers, value per subscriber is equal to market value of equity shares or market value of equity plus debt divided by number of subscribers. And fourth industry, typically ad based internet firms, in such scenario value per site visitor is equal to a market value of equity plus debt divided by number of site visitors. Benefits of this sector specific multiples is that useful for private companies or industries lacking the active market comparables. Obviously, if at all it's a private company, it's very difficult to find a comparability also, and in such scenario the industry sector specific multiples becomes useful and handy. Allows flexibility through sector specific or operational metrics. And third benefit is can value firms with non-comparable or missing financials also. So with this, in a way, the earnings multiple chapter is over, and we will see now in the chapter, in the study material, there are short question answers and long question and answers. As my practice has been, I am covering the concepts that are being dealt with in the respective short answer as well as long answer. So this is the short answer summary. So first question deals with comparable transaction method process. And typically in broader sense, the process involves identification of comparable deals, because similar kind of transactions have to be identified so as to use it for valuation. Then comes calculate multiples. Then third step would be adjusting or adjustment for the differences between the transaction being compared and transaction at hand. Apply to the target transaction and assess the value range. So this is the broad process which is being followed in comparable transactions method. Second short answer deals with EV upon sales versus P price upon sales comparison. So EV to sales includes debt and equity, offering a broader view than price to sales, which only reflects equity. Third short question and answer deals with the EV to sales calculation example. So let's assume EV is equal to $2 billion and revenue is equal to $500 million. Then EV to sales equal to sorry. Yeah. Then fourth question deals with size discount impact. Sorry, just a second. Yeah. So fourth question deals with size discount impact. In that it avoids overvaluation in small or early stage firms is being dealt. Fifth question deals with sector specific multiples uses. Useful for industry comparability, avoids accounting distortions, and works with incomplete data also. Sixth question deals with subscriber versus visitor metrics. So subscriber is for recurring revenue models and visitor typically is for ad driven models. Yeah. So EV to sales comparison, typically company A versus B. So B's EV to sales is 0.8 and A's EV to sales is 4. Then B is valued lower per unit of sales in a way. Eighth question deals with policy impact analysis tool, which uses EV to sales for a full enterprise view, including debt and equity impacts. So this is what policy impact analysis tool is. Then long answer summaries is being covered. So over here, typically, as I said, after the study material or the relevant chapter, there are long question and answers that have been given in detail. So the concept that is being discussed in those long question and answer are, in question and answer 1, the comparable transaction method is discussed. So the valuation is values based on private or comparable deal multiples and essential in niche or unlisted sectors. Example, EdTech. Then in second long question and answer, the concept that is being discussed is exercise in a way for a EdTech valuation. So in that, provide PE multiples from Byju's and Vedantu, and then students are asked to apply adjusted multiples to startup metrics, applying size discount if needed. Third exercise is in third question there is an exercise on sector specific valuation. So industry is about streaming industry, and what is provided is market value of equity, debt and subscribers, and typically what has been asked to compute value for per subscriber and apply to target firm's base. The pros and cons of sector multiples typically are being considered over here in question number, long question answer 4. In that the pros are simple, not reliant on financial statements, that are the pros, and cons are the ignores firm specific nuances and assumes sector homogeneity. So these are the cons or discount on fundraising, and in that it may limit valuations in future rounds but attract value seeking investors. So in a way, with this we conclude the session or the chapter, that is earnings multiple. I'll quickly recap the entire chapter. So we started off and summarize the chapter also. So we started off with earning multiples. Hello. Yeah. Sorry, the mic was like a bit, the battery is got discharged, and that's why I had to step out for a minute. So we saw when to apply, use the market value approach when the asset was recently sold under relevant conditions and the asset or similar ones are actively traded publicly, and there are frequent and recent comparable transactions. When not to rely solely on the relative valuation, typically avoid or supplement the market approach if the business or its comparables aren't actively traded, comparable assets are limited or too different, and transaction data is outdated or unavailable. Then we saw the various valuation methods that are used in relative valuation. Equity multiples, so use ratios like price to earnings or price to sales. Then second method is the enterprise value multiples, wherein use of EV to EBITDA or EV to revenue is done. Typically enterprise value is equal to market value of the equity minus cash minus short-term investments, and equity value is calculated as enterprise value minus liabilities and minus preference shares capital. Then we saw the market price method, wherein use of volume weighted average price is being used over a reasonable trading period to avoid distortions from single day price fluctuations. Example, market prices as on 31st March 20 were unusually low due to COVID-19 impact, because in the last week of March 2020 itself the COVID was declared and there was a big lockdown, etc., as we all know. The entire world and the various economies came to a standstill, but it got normalized over a period of time. So in short, the market prices as at 31st March 2020 for all the companies were unusually low. So that therefore market price, that's what market price method is typically being considered to avoid distortions from single day price fluctuations. It is applicable for assets traded in active market. If an asset is traded in multiple markets, use the market with the highest trading volume for valuation. So obviously if at all a particular stock is being traded usually in BSE and NSE, and if between the two, wherever the highest volume trading volume is happening, that market will be considered for valuation. Now this market price method in a way ensures a more stable and accurate valuation by averaging out short-term volatility. If an asset is traded in multiple markets, use the market with highest trading volume for valuation, ensures a more stable and accurate valuation by averaging out the short-term volatility. This valuation method estimates an asset's value by comparing it to identical or similar assets with available price data. So that's market price method for you. Now there is another method which is called as comparable companies multiple method, CCMM, known as relative valuation. Values an asset by comparing its valuation multiples to those of similar actively traded companies. So some kind of a comparable valuation multiple is determined or identified between the two or more companies, and that valuation multiple is compared to give a valuation to the actively traded companies. So steps involved in CCMM are typically identify comparable assets and gather their market data, that market value, that's the first and foremost step. Secondly, standardize these values using price multiples to enable comparison, obviously. And third step would be compare the assets multiple to those of its peers, adjusting for firm specific differences to assess undervaluation or overvaluation. The key metrics used in CCMM are typically the price earning ratio. The PE ratio typically is market price per share divided by EPS, earnings per share. A higher P suggests a stock is more expensive relative to the earnings. It reflects investor sentiment and growth expectations. Earnings yield is equal to 1 divided by PE ratio, an estimate of expected return, and market price per share is equal to EPS into PE multiple. Types of PE ratios are trailing PE, that is TTMM, used on actual earnings over the last 12 months. Then we saw this trailing PE is most commonly used. Forward P is all about based on forecasted earnings for the next 12 months, less reliable during volatile periods. Variants depend on how price and earnings are defined, example recent year average or future estimates. A note for valuers often prefer trailing PE from continued operations to exclude one-off or non-recurring items for more accurate valuation. There is another then PE that which is called as fundamental PE or justified PE. The fundamental PE or also called as justified PE is derived from the Gordon growth model, that is GGM, where is V0 is equal to D1 divided by R minus D. Dividing both sides with the next year's forecasted earnings E1, one gets the leading PE ratio. So V0 divided by E1 is equal to D1 divided by E1 divided by R minus G. Just a second. Yeah, that's better. So this form shows that the fundamental or justified PE is based on dividend payout ratio D1 divided by E1, required rate of return, that is R, and expected constant dividend growth rate, that is G. So the key points of fundamental PE or justified PE ratio is that it is called as justified because it is grounded in valuation theory and reflects intrinsic value. It is forward-looking leading ratio using forecasted earnings E1 rather than past earnings. And thirdly, it clarifies how PE should align with the firm's fundamentals and serving as a benchmark for valuation. Then we saw the book value multiples, that is price to book ratio, PB. The price to book ratio compares a stock's market price to its book value per share. The market price per share divided, so PB ratio is equal to market price per share divided by book value per share. The key insights over here in this type of ratio is that a low PB ratio might indicate that a stock is undervalued, but it could also signal underlying issues. Industry context matters, so PB is especially useful in asset heavy industries like banks. The ratio is influenced by accounting practices because it uses values from the balance sheet. The estimation consideration in this book value multiple is that future book value per share can be projected using the sustainable growth rate G. So for that, G is equal to ROE into retention or into retention rate. So that's how the calculation of growth is done. Adjustments to book value typically revalue fixed assets. Example, PP and E to reflect plant property and equipment to reflect fair market value. Includes off balance sheet liabilities, example guarantees and contingent liabilities. Excludes non-operating intangibles, example goodwill, but retain operating intangibles like patents or copyrights. This ratio helps assess whether a stock is priced appropriately relative to its net asset value, particularly in firms where intangible assets play a key role. So this is how adjustments to book values are done, and typically book value multiple ratio or price to book ratio in a way helps assessing whether a stock is priced appropriately relative to its net asset value, particularly in cases of firms where tangible assets play a key role. Then we saw the revenue multiples, which is price to sales ratio, PS, P to sales. Price to sales ratio measures a company's valuation related to its revenue. So PS ratio is equal to market capitalization divided by total revenue, that is trailing 12 months, or on a per share basis current stock price divided by sales per share. Key points over here in this multiple is that useful for startups or loss making companies where profit based metrics like PE or EV divided by EBITDA aren't applicable. Lower PS generally suggests better value, but the ratio should not be used in isolation. Best suited for growth companies with strong and consistent sales growth. The PS ratio can be volatile, so it requires careful interpretation alongside other financial indicators. Then we saw price to cash flow ratio. So in price to cash flow ratio, P to CF ratio is a valuation metric comparing a company's market value to its cash flow. So P to CF is equal to market capitalization divided by total cash flow is equal to stock price divided by cash flow per share. Types of cash flow that are followed or used are PAT plus non-cash charges, which is the simplest cash flow but omits some non-cash items. Adjusted cash flow from operations, CFO, more refined than the first. The free cash flow to equity, FCFE, most appropriate, reflects cash available to shareholders. EBITDA. Often used but influenced by accruals, not a pure cash flow measure. The key points to price to cash flow ratio are that P to CF is helpful when earnings are distorted by non-cash items. It provides a clearer view of a company's ability to generate actual cash, and FCFE is preferred to its accuracy in reflecting shareholders' value. Then we saw the enterprise value to EBITDA, EV to EBITDA ratio, the EV to EBITDA ratio, also known as the enterprise multiple, is used to value cash generating businesses by comparing their overall business value to operating earnings. Formula wise, it's EV to EBITDA is equal to enterprise value divided by EBITDA, where enterprise value is equal to market capitalization plus debt plus minority interest plus preference capital minus cash, and EBITDA is equal to PAT, that is profit after tax, plus taxes plus depreciation plus amortization. Key characteristics: EV represents the theoretical acquisition cost, what it would take to buy the business debt free. EBITDA allows comparison across companies by removing the impact of capital structure, taxation and non-cash charges. Unlike price to earning, EV to EBITDA is not influenced by financing decisions. It does not reflect actual cash flow and is susceptible to accounting manipulation. Equity value can be inferred, that is equity is equal to EV minus debt. The advantage of enterprise value to EBITDA ratio is that it's better for comparing companies with different capital structures, and it reflects total business value, making it deal in mergers and making it ideal in mergers and acquisition analysis. Then we saw the CTM, that is comparable transaction method, or also called as guideline transaction method. The comparable transaction methods values a company based on multiples from recent transactions involving similar companies or assets. It's especially useful when publicly traded comparables are unavailable, such as in private or niche industries. The key steps involved in comparable transaction methods are: first, identify relevant comparable transaction, example same industry, size, geography, etc. Extract transaction multiples, example EV to EBITDA or EV to revenue from these deals. Adjust for differences between the subjected asset and the comparables, example size, stage, performance. So for these differential aspects, adjustments have to be done. Apply adjusted multiples to the subject company's relevant metrics and thereby assess the range of values if using multiple metrics, and use judgment to finalize the valuation. For example, in valuing an edutech or edtech startup where no listed comparables exist, private equity transactions, example Byju's, Vedantu, can serve as a benchmark. For early stage firms, size discounts may be applied. Then comes the sector specific multiples. So these are used when accounting data is limited or unreliable, focusing on operational metrics. So industry wise, the metrics that are being used are steel. In steel industry, value per ton of steel produced is being used. Then in case of electricity, value per kilowatt hertz is being used. For subscriptions, example internet service provider, ISPs and Netflix, the value per subscriber is equal to market value of equity plus debt divided by number of subscribers. Ad-based internet firms, value per site visitor is equal to market value of equity plus debt divided by number of site visitors. So So benefit of this sector specific multiple is that it is useful for private companies, for industries lacking active market comparables, allows flexibility through sector specific or operational metrics, can value firms with non-comparable or missing financials. Then we went through various short answer summary. In that we saw the first short question answer was about comparable transaction methods process, which involves identifying comparable deals, calculate multiples, adjust for differences, apply to the target company and thereby assess value ranges. Second question was about EV to sales versus price to sales. So EV to sales includes debt and equity, offering a broader view than PS, which only reflects equity. Third was about EV to sales calculation example, where EV is equal to 2 billion, revenue is 500 billion. So EV is equal to sales is equal to 2 billion divided by $500 million. Size discount impact, so avoids overvaluation in small or early stage firm. Continuing with the short answer, fifth question deals with sector specific multiples useful for industry comparability, avoids accounting distortions and works with incomplete data. Sixth question dealt with subscriber versus visitor metrics. Subscriber is for recurring revenue models and visitor metrics is used for ad driven models. Then seventh question deals with EV to sales comparison. Company A versus B is compared. So B's EV to sales is 0.8 and A's EV to sales is 4. So thus B is valued lower per unit of sales. In the eighth question, the policy impact analysis tool is being used. Use EV to sales for a full enterprise view, including debt and equity impacts. The long answer summary dealt with comparable transaction methods, wherein value based on private or comparable deal multiples, essentially in niche or unlisted sectors, example education tech or ed tech. Exercise was given in question number 2, which is about ed tech valuation. In that, provide EPE multiples from Byju's and Vedantu, and thereafter to apply adjusted multiples to startup metrics. Then third question deals or is again an exercise which is given on sector specific valuation, and the industry being considered is streaming industry. So data that is to be provided is market value of equity, debt and subscribers asked to compute. So typically it is asked and the values to computed per subscriber and applied to target firm's base. Fourth question deals with pros and cons of sector multiples. So the pros in a way simple but not reliant for financial statements, and cons or disadvantages that it ignores firm specific nuances, assumes sector homogeneity. Fifth question deals with effect of early stage discount on fundraising, wherein it may limit valuations in future rounds but attract value seeking investors. So thank you, and with this we conclude to the session or chapter number in a way 7.2, which deals with earning multiples, and which the overall module has a weightage of 15%. So in this 10%. So in this 10% there are 4 chapters, out of which one is this earning multiples that one has to study, and typically I have referred to the study material only that has been provided, and more specific each concept I have read through and I have tried to concisely put across in this PowerPoint presentation and thereby explaining you in this session. So with this we'll conclude the session for earnings multiples, which is chapter number 7.2 of paper 20A, which is about strategic performance management and business valuations. So signing off here, CACS Pushkaraj Vishnu Doshi. See you in the next session, which will be about the next chapter from the same module. So see you. Thank you.